What's going on, everybody? Welcome to a capital hungry market analysis and trade ideas webinar. It is currently Monday, September 11th, end of the North American trading session, just coming to around 5:15 p.m. Eastern. Perfect time to do some fresh analysis for the coming sessions for a day trading and scalping perspective. Now, something that we were discussing in detail during our New York scalping session this morning was, of course, understanding market waves and market conditions. We can see in the example of dollar, we have obviously been playing some more macro bulls on the sentiment of the Feds keeping interest rates up higher for longer as inflation is seeing signs of trouble back into the sticky zone around 3% and lower. We know it's going to take more sacrifices within the US economy to attain those goals of inflation back to 2% and, of course, maintain it there, signaling that the Fed have completed their job with tightening of financial conditions and bringing inflation down and potentially achieving their goal of a soft landing, which is extremely, extremely rare. Now, as that macro sentiment has held the most weight, dollar over the last month and a half or so has, of course, been extending into higher highs with buyers in control. This has obviously kept pairs like GBPUSD and Euro USD more bearish and has obviously kept some pressure on gold as economic data has still remained resilient. We have, of course, started to see signs of weakening in economic data due to policy lag effects, but nothing that's fully shaking the soft landing narrative or starting to signal any deep recession scares yet. That still looks to bubble up into 2024 as policy lag effects will be a lot more prominent during that period of time. But anyways, overall, as dollar has been bullish on that macro sentiment, we've only seen some short-term secondary phases of market structure, which primarily come from new intraday highs being printed or failing to break previous intraday highs. Now, sometimes these pullbacks can just be normal order flow of buyers exiting positions, sellers jumping in hand, providing that exit relief, of course, pushing price down to lower demanded prices before buyers jump in and extend the trend. But a lot of these pullbacks have been data or event driven. For example, this was August NFP and unemployment numbers. This was the CPI data shortly after. This was poor JOLTS job opening and ADP private sector reporting. One of these minor spikes down here was when China was doing currency interventions, or one of these was PMI data, and back here was when China did a currency intervention. So it's very common that amidst the overall bullish structure, we get these data or event-induced pullbacks. With what we're looking at price setups for this week, we can easily also see that occur going into the inflation data, with price setups into the next couple of days until CPI, and even CPI itself still doing some aggressive intraday liquidity grabs to lower buyer demand zones. But if inflation still remains elevated, which we expect it to be back into the sticky zone, seeing some signs of trouble here, then higher CPI is going to have the markets price in rates up higher for longer and bring the demand back into dollar. When we're looking at dollar right here, dollar bulls are still in control, even if we come all the way back down into the 103s again. But our first area of interest we're really going to be looking at is, of course, around the 104s here, around previous intraday highs. But you can see here, when we had this accumulation phase here and printed new intraday highs, we had a pullback to that same accumulation zone, then had more optimistic US PMI reporting, leading to new highs being printed. Having pullbacks to this price point where we've seen buy orders accumulated before, even a more aggressive pullback into this area, dollar on the higher time frame and intraday would still be very bullish. One thing we have to understand is this dollar structure we've been playing has been very clean. It's been pretty textbook. Higher highs being printed, data-induced pullback phases, retesting previous highs or intraday liquidity zone, and then just continuing the trend, right? It's given us the deeper corrections on gold, still holding the macro bias of bears below the 1980s. It's given us that GBP USD and Euro USD bearish structure as dollars your world reserve currency, and you still have that macro rate differential. And obviously, it's kept USD CAD a lot more bullish, and the dollar strength has kept stock market more subdued, not because dollar's just bullish and that's the only reason in itself, but because the markets are starting to price out the chance of 2024 rate cuts and starting to price in rates being up higher for longer, especially if we still get some hot inflation reports to close off the year, with CPI in heavy focus, of course, in the middle of the week. But what I was trying to say is this dollar upside has been textbook. What's very common when you look at dollar movement, especially during the dollar domination phase, but even before, even after that as well, is as dollar can be marking up these higher highs and overall trending very bullish, having these larger corrective waves where for a period of days or a couple of weeks, you can have these larger corrections to set up better pricing before accumulating more volume and continuing the trend, as long as the macro sentiment doesn't break. This is very normal on dollar movement. Aggressive pullback waves. So when you bring that to what we've been playing here over the last month or so, pretty much since mid-July, almost 2 months coming up here, right? This has been textbook clean structure. I just want people to be prepared with some of the exhaustion we may be getting, digging into these important liquidity zones on the higher time frame here. With how we're showing exhaustion here, it wouldn't be out of the ordinary to get pullback phases, which a normal controlled one into 104 is absolutely nothing at all before seeing any type of bounce. But we could easily, as stated, be going into the mid 103s here and still be maintaining buyers in control, just having an extended corrective phase, buyers liquidating positions from these highs. It can even be data induced with like a downside liquidity grab on the CPI day as well, being aggressive, but then still continuing this macro trend. The only way this week, with some of the data we have in focus, that I can see a reversal on the dollar and complete shift in structure and sellers coming back into control is inflation reports would have to be significantly declining closer to the 2% goal of the Fed, which I think is highly unlikely. It's always a possibility, but that would be a reason to see, instead of just a short-term pullback on the dollar that may be data-induced and only last a session or two, instead of seeing that, you'd have a complete stronger reversal and bears in control, digging a lot lower into the 102.5s and 102 prices. But we don't have that declined inflation report. We don't have insider information, so we can't just hope and pray and guess for that. It wouldn't really be a good bet or a high probability bet in current situation. What we do have right now is dollar showing a repetitive pattern where it looks like, obviously, we're showing exhaustion from buyers around that 105 price point. We don't have any economic data really in focus for the US economy in the first half of the week. We have some of the more important events in the second half of the week. So we could see dollar bears in control and just prices subdued on the dollar, potentially setting up into the CPI day, where corrections down into 104 seems very, very normal as our first area of interest. Deeper pullbacks would be into the mid 103s there. But our first area of interest is starting to look at the 104s. Now, understanding when we're looking at key economic events, that we don't really have anything going on through the Asian session. Over London session, we do have some UK jobs figures where it's expected to be bad data. It's already expected to be bad, so we're going to have to exceed these poor expectations, which would support the potential GJ deeper sell pullback we're going to be talking about below that 183.5 price point, as it does look like GJ is potentially entering a higher time frame correction phase as well, having a correction against the macro bulls. So this is all that's in focus overnight. Inflation figures for Spain are still forecasted to be relatively the same. Won't give too much indication towards ECB policy positioning. It's just this data for the UK, which is expected to be bad. But for it to hold weight in terms of bringing some GBP weakness, we're going to have to see unemployment rate come out at 4.3%, but preferably higher. And this employment change is already skewed even deeper into negative integer territory. So we can come out lower than that, but it'd have to be like minus 200K to hold some weight on GBP bears. Other than that, not much going on through the North American trading session. We don't really have the important US economic data until midweek there, September 13th, with our CPI reporting. And then the following day, we have the ECB rate decision, jobless claims, and producer price index. It's relatively a quiet week for US data. We just have the one in focus report, which is obviously inflation, to give the market signals towards future Fed policy positioning. Now, we're mainly looking at CPI year over year, the headline here. This is already expected to be quite higher. 3.6% is a pretty aggressive bounce. But even if we come out at 3.5, we come out right on forecast at 3.6, it's still going to show that inflation is seeing troubles back into the sticky zone, and it's still going to hold weight for bringing the market focus back on Fed's rates being up higher for longer, aka dollar strength. The only difference is the size of the market movement is going to be dependent on the result of this data. So if we come out at 3.5%, it's still a significant increase from prior. It's still only 0.1% below the forecast. It's still showing inflation is having trouble back into the sticky zone, and the Feds need to keep financial conditions tighter for a longer period of time, right? But it's not going to hold as much weight if this figure came out at 3.7 or 3.8. So just keep that in mind. But I can personally still see inflation being elevated, and up until Wednesday, dollar potentially just being in a bearish pullback phase, setting up buys if inflation is still elevated on the Wednesday there, give or take a liquidity grab, or just continuing bullish after retesting a more favorable demand zone and better intraday buy prices there. But that's just a little bit of yapping and forecasting into the week. In terms of economic data, we don't have much going on through the Asian session. London session just has the UK jobs report, which is expected to be poor, but because forecasts are already expecting bad data to hold negative weight and bring some British pound weakness, we're going to need it to exceed those negative expectations and see employment change come out at like minus 200K, unemployment rate be right at 4.3% or preferably higher. Nothing really going on through the North American trading session. So on dollar, gold, and US equities, I'm expecting less volume and volatility still. For example, when we look at the Japanese candlesticks, you can see the night and day difference in terms of the size of candles when you get optimistic data, like in these situations, or even after that NFP day where we had optimistic PMI, or you can see some of the more aggressive pullbacks that are data induced, like this was an NFP day report. This was a CPI liquidity grab before continuing higher, which I would love to see a repeat of something like that going into Wednesday. This was the ADP private sector reporting being poor and JOLTS job openings being poor. So you can see the night and day difference of obviously when you have more volume and volatility, whether it's data report or event based. What it looks like we're going to be seeing up until Wednesday, if we don't get any reactive events and headlines, is more something like this. Slowly creeping our way down, potentially going to retest the first area of interest around the 104s. So we could see very small candles, no major directional volatility, slowly creeping our way down, even into CPI, liquidity grabs into this area, and then starting to get some impulsive moves back into the highs if inflation is still elevated, which I think it should be. We'll be giving, obviously, a data dump and breakdown on CPI data the day before on research of why we think it should be elevated, the potential numbers we can see in terms of the results, and the potential impact and scenarios. But this looks like the pathway of price dollar is going to be taking place, or literally just consolidating before seeing some liquidity grabs before continuing the trend there. So one thing we have to keep in mind is it's great to do analysis, identify your key price points of interest, understand the fundamentals, forecast for the week as well, right? It's fantastic to do that and stay in tune with what's going on in the markets. Perform these productive events and use your time efficiently, but understanding market conditions, you also have to lead it to helping you make better decisions with your trading, right? We were talking about that during the New York session, where a lot of traders mainly lose money in poor market conditions. When you're having aggressive ranging, very minimal movement, they end up zooming in on the lower time frame, getting lost in the noise, entering buys and sells every 20, 25 pips of movement, and getting burned and exerting their energy, exerting and wasting their capital in poor market conditions. Then a couple days later, we have important economic events and you get one-sided volatility and you have very clean confirms to grab your piece of the pie with increase of volume, of course, like during these situations highlighted in green or red, or the continuations move back to the highs. Then this individual sitting on the sidelines. Their confidence has been shot. They're not feeling good mentally. They've already burned through their capital. They're going to get even more FOMO because they see everybody else catching these trades and they burned their account earlier in the week when market conditions were poor, right? So I already have expectations that US dollar, gold, US equities, of course, dollar pairs, they're going to be relatively messy on the lower time frame and intraday. It's going to be lower volume and volatility up until the second half of the week. Second half of the week, we got CPI. For Euro USD, we got ECB rate decision, where there's just expected to pause, but at least it's going to bring some volume into play alongside potential dollar strength coming back in by then. And of course, we got jobless claims, consumer confidence report, and so forth to close off the week. So I would highly advise when you're looking at dollar movement overnight, or you're looking at gold or even equities, if you're not seeing larger intraday candles, if you're not really seeing any clean lower time frame price action, it's best just to sit out until you have the larger volume induced moves come back into play. But I want to start out here with dollar, where it looks like dollar, especially when we're zooming in more on the intraday, it looks like as long as dollar's holding below that 104.5 price point, we're just going to be in a secondary phase of market structure, creeping our way down slow and steady to retest into this previous accumulation zone and previous intraday highs, roughly around the 104s. So if that does take place, in terms of trade ideas, that's going to translate pretty cleanly where short-term dollar softness could still see some gold upside, potentially setting up prices into CPI. We could see Euro USD have a pullback phase from its intraday lows. GBP USD have a pullback phase from its intraday lows. USD CAD have a pullback phase from its highs and so forth. It's very difficult for me to jump right back into a dollar bullish bias without having the data to support it and the volume induced from like a higher CPI report or jobless claims still being in healthy ranges, or without seeing clean bullish price action well back above 104.8 and trading above the highs. What looks more increased probability is dollar just consolidating with less volume or volatility, or having that pullback phase into at least retesting the 104s there. So when we bring that information together to our dollar pairs or something like gold, we can see overall, we're still macro bearish on gold into the end of the year, as I'm expecting more of the global geopolitical tensions or policy lag effects to become more apparent into 2024, where we may see gold catch a bid for its safe haven, appeal for its safe haven side, right? Otherwise, as long as gold is holding below that price sensitivity area where we saw rejections around 1950s, I could see us just having short-term upside into there, creating a technical double top, collecting some more sell orders before still chugging down into the 1900s and still even having larger bearish corrective waves into the 1800s, setting up prices into 2024 when we really see shit pop off in economies in terms of geopoliticals, right? So if dollar does remain softer, and when we're coming to look at gold here on the intraday, as we're just in a consolidation at this exact same previous liquidity zone, if we come back above 1930s, I would see short-term buys up into the 1945s before fading out into sells. Otherwise, as we have expectations of low volume and volatility, just stay out of this. This is where traders get burned the most, wasting their capital, wasting their time, wasting their energy, stressing out. And then when the impulsive moves take place, they're sitting on the sidelines, right? So before CPI, I would love to sweep the highs and retest better sell zones before continuing lower with dollar strength coming back into the table. Otherwise, pretty clean sells would be only if we break below the 1917s, where we'd expect these moves to get mirrored. But I don't think that's going to take place until potentially later in the week. So if gold is just consolidating, no point taking any trades. Short-term buys we can see to sweep those highs before continuing lower, or breaks below the lows continuation trades. It looks like pairs like Euro USD and GBP USD are going to enter a secondary phase of market structure. We can see on Euro USD, we're retesting into this previous liquidity zone and last intraday higher time frame lows there around 1.07 from June. Overall, sorry, I accidentally hit the mute button. Overall, Euro USD is very bearish, but getting aggressive pullback phases, especially as we can identify dollar exhaustion is not out of the ordinary at all. So if we fail to break new lows, giving price setups into Wednesday and seeing retests into the 1.083s would not be out of the ordinary at all, in my opinion, before potentially seeing sellers come back into the market. Similar idea on GBPUSD, where if we don't print any new lows, we could easily see a deeper pullback phase going up into the 1.26s before sellers come back. USD CAD, we could easily get retests. As you have to understand, we've been talking about this key price point where we can get exhaustion around 1.365. We broke a little bit above there at 369, but it was very short-lived and we're still closing below there. So UCAD could easily be coming back down to 1.35s, where we saw buy orders accumulated before possibly seeing any dollar strength come back into the table. Basically, if we can identify that dollar exhaustion, dollar having that deeper pullback to 104s, it'd make more sense for Euro USD, GU, and UCAD to respectively have some corrective phases as well. And it makes sense for gold if it breaks above 1930s to sweep into these highs again before anticipating any further sells. So we understand that with dollar pairs. Dollar softness in the example of US 30 can also see us coming back to retest into this accumulation area where we had this previous rejection, potentially setting up prices into CPI as well. I'm not expecting major meltdowns on equities, but it still creates some price stability and market balance where if we sweep these highs first, then come back down to the same prices, you're just coming back down to those same that same demand zone again around 34,200. On our Japanese yen pairs, over the weekend, not even over the weekend, Friday market close at 5:04 p.m. Eastern, that control UEDA had to give some signals and hints that they may have enough data by the end of 2023 to start tweaking their policy positioning and coming out of negative interest rates. So that ended up sweeping out my buys that were over here at 183.3 that I thought were fantastic entries that I could have held into this week. But because of that, it's all good. We remain adaptive and we stay objective. Now, one thing we have to understand is the GJ bulls we've been playing since like March have been absolutely blessed. Bank of Japan just continues to cement their ultra loose policy through this. UK inflation figures remain elevated, so Bank of England needs to stick to keeping interest rates up higher for longer. Macro rate differential holds the most weight. No major fear, uncertainty, or doubt to shift market sentiment during this period. Minor data-induced pullbacks or that bullshit with UEDA that he did here with the rumors and headlines of YCC, yield curve control tweaking, before the Bank of Japan rate decision. But besides that, it's been smooth sailing buys. One thing we have to understand is GJ, this has been smooth sailing. Normal GJ upside, I don't want to say normal, but more historically accurate upside, even if you look at previous larger bullish higher time frame runs, like after the 2008 global financial crisis, as GJ is making its way overall to the upside here, increasing in value on the macro, this is very normal to see these large higher time frame corrections, usually from new intraday highs or higher time frame highs, right? As we're looking at the major signs of exhaustion at 186, as we're potentially seeing some strength come into the Japanese yen there, if we hold below that 183.5, 183.8 area, especially as we printed some new minor intraday lows below that demand zone, seeing a larger corrective wave on the British pound against the yen here, even into the 180s again, would not surprise me at all, right? And we have to be ready for that. Obviously, we've been playing the macro bulls, but it's very easy from a psychological perspective to just get accustomed to this, where literally every week you're just looking for pullback buys, breakout buys. UK data still supporting Bank of England keeping rates up. Bank of Japan speakers still saying they're going to keep ultra loose conditions, no shift in structure, clean price action, pullback buys, breakout buys. Right? What happens is if you get too psychologically attached to a bias where we are not investors, we are day traders, when you have one of these inevitable larger corrective waves that can be event driven or data driven, like for example, banking sector failures, or for example, during the pandemic, like new COVID variants were coming out and fear regarding that, right? When you have those inevitable larger corrections, the trouble is people will still just be continuously looking for buys at every single dip, right? Every single minor dip, they'll still be looking for buys as GJ will go down bearish 300, 400 pips, having a normal correction before continuing the overall trend, right? So that's something we have to be careful with here. When we're coming to look at GJ here, we can see we're starting to show a bit of a break below this price sensitivity area. We're clearly showing a lot of exhaustion from those new higher time frame highs that were printed as we were getting closer and closer to the pre-Brexit crash prices on GBPJPY here, which was just into the 190s, right? So we're clearly showing a lot of exhaustion here. That headline over the weekend, even though it didn't bring major impact like the last Bank of Japan yield curve control bullshit, where then the rate decision the following hours later just faded it out, even though it didn't have huge impact, it did at least lead to new intraday lows being printed here. This may be signs of a secondary phase of market structure starting to take place where we could easily be going back into the 180s, 181s before seeing buyers enter the market at lower demanded price points. And having a correction when you're zooming out here and understanding this overall bullish structure, having a correction to the 180s is a blip. But for us as day traders, scalpers, trading on the intraday time frames or certain sessions, that's very important if we can anticipate that pullback. Does that make sense to everybody? Okay. Now, on UJ, you still have obviously dollar still holding more macro strength. And obviously, if dollar strength comes back into the table, you can, of course, see if dollar strength comes back into the table and inflation figures are still elevated later in the week there, right? You can, of course, still see UJ holding more bullish. But I wouldn't be surprised at all if, as we're approaching this previous highs price point here, seeing a larger, higher time frame correction or consolidation being created before correction would not be out of the ordinary. So we may see UJ still holding bullish, but not really printing any new highs, just starting to create more of a higher time frame range. Because if UJ starts to go up too aggressively, starts to go up too much, too fast, volatility-wise, right? What the Japanese government fears so much, we see in those Asian headlines every single day, then it's just going to lead to currency intervention in an inevitable, more aggressive correction that took place here. But if the upside is relatively controlled and subdued, going up in waves, then it decreases the chance of seeing currency interventions take place, because obviously it's not as volatile if the yen's not just free falling and dollar's not just soaring, right? But anyways, just want to talk about some of the fundamentals there: price positioning, market waves, market phases. Now let's just jump into what everybody cares about, which is the trade ideas for the coming sessions. Keep in mind, expecting gold, dollar pairs, and equities to still be relatively quiet overnight. We can see dollar potentially catch a short-term little bid and buyer move overnight if UK data is very poor, just from a safe haven perspective. But other than that, I'm expecting no major moves on gold, dollar pairs, and US equities until the second half of the week. Primarily looking at secondary phases of market structure. Now, from about 1920 to 1928 is a no trade zone. But if we break above 1930s, I would see short-term buys into the 1945s before starting to even a little bit higher, but still closes around 1945s before starting to jump back into our higher time frame sell side bias on gold. Otherwise, continuation sells are going to have to be below these candle bodies, clearing below this range, printing some new intraday lows, especially if dollar buyers just come back into the scene without a secondary phase of market structure, below 1917 and below 1912s. Staying out of this intraday range, not going to waste much time if I see very small intraday candles and not much movement. With Euro USD, we have the potential for a deeper pullback phase that can easily take place still, even setting up into ECB rate decision and CPI data. I would see short-term buy plays from 1.073 key level, break above current intraday prices that were just printed around 1.076, at least going to retest before assessing any sells around the previous lows and around 1.08. Otherwise, only safe continuation sells with dollar snapping back bullish, printing some new intraday highs, and sells below 1.07. And honestly, with CPI data and ECB rate decision, this pullback can extend a lot deeper. It could go to 1.084s, 85s, no problem. Just with the volatility we could see in the second half of the week. GBP USD. Just making a lower wick on the new daily and still holding above 1.251, 1.254. Still see some short-term pullback phases to retest into better sell zones, adapting to the different market waves, change in volume and volatility there. Otherwise, any safe continuation sells, if we don't get better sell positioning to continue the macro trend, is going to just have to be breaking the lows. USD CAD rejecting key higher time frame price points of interest. Looking like pullbacks can be extending into the 1.348s we were talking about here. Would still see the sells below key level into at least retesting that area before assessing any buys. Otherwise, to jump back into buys from current prices, we'd need to be clearing back above 365. UJ potential for some more exhaustion signs in a secondary phase of market structure if we trade below 146 and 145s. Otherwise, only see buys if we break the highs, as if it's important prices around the last intervention prices. And of course, the same time, we might get a shift in sentiment short term on the yen due to those weekend headlines. Just can hold a little bit of weight on yen strength. Otherwise, we need to be breaking out above there. US 30, I can still see on dollar softness, buyers holding that demand zone around 34 300s, 34 500s. Still see buys from these prices up into retesting into the 35 150s there before assessing sells again. Sells at some better positioning near that liquidity zone. We saw this previous sell-off that we identified around 35 100. Otherwise, any safe continuation sells would need to be below 34 300. GJ price action is pretty poor, but we understand why from those weekend headlines and indecision. Now, the one thing is we still have this gap. So we could see a short-term squeeze to retest into the better sell zones like we were talking about during our New York session. Just filling the gap, making that upper wick, but then still ending up getting faded out there. So I'd see some buys for about like almost a 70, 80 pip range before assessing better sell positioning. Otherwise, holding below 183.2, breaking below 182.5 looks like a deeper corrective wave taking place on GJ, especially if we see yen strength holding and holding below that price sensitivity area when we were previously looking at GJ there. All right, so keep in mind, we went over some key fundamental review, what we have going on during the week, market expectations in terms of volume and volatility, breaking down market waves, talking a little bit about macro, a little bit more zoomed in on the intraday, and then some trade ideas there.